So I'm a tax partner with DGC, Digital Gilman and Company. We have offices in Woburn and Boston. I know several of the people on this call are familiar with our firm. We do have a very, what we consider to be a very significant practice servicing architects and engineers. So it's an area that we are very, very proud of as far as the size of our practice, and we feel that we certainly bring a lot to the table when it comes to this industry as far as your accounting and tax needs. As Ann mentioned, I will be talking about the employee retention credit. I'll give a little bit of an update, a little bit of a, for people that may not be familiar with it, I'll give a little bit of a background and a little history of it, but not too much. The main focus is sort of on the interaction between the credit and the PPP loans, because I think that's probably one of the more difficult areas to deal with respect to the credit. And certainly if there's any questions, we can talk at the end with the questions, or if people have something specific as we're going along, feel free to jump in as well. But there certainly will be time at the end. I don't anticipate that this should take longer than a half hour, but sometimes you never know once you get going. This slide is just a little bit about our firm, me without a beard, and my contact info. And as I said, I'll talk about a little bit of the legislation, the history, and some of this is going to be tax lingo, so just you can ignore that part of it. I sort of grabbed some of these slides from a presentation I did for my firm earlier this summer. So I rather than changing all the slides, I just kept some of them as is. I'll talk a little bit about the IRS notices that have been issued and other guidance that, in case people are interested in sort of poking around and reading some of this stuff, just so you're aware of what's out there. And also the most importantly, I think, the interaction with PPP loans and related planning. As far as the history goes, the employee retention credit, which as we'll talk about, can be a very significant credit. Really, depending on the facts and qualifications, we've seen we've seen credits from as low as 10 to 15,000 to as high as just not a very large ones, but 300 to 400,000. And I know there's been credits claimed in the millions of dollars. The employee retention credit, if you do qualify, and can be a very significant, can be a pretty good size number. It originally was enacted by the CARES Act, which was the same law that enacted the PPP loans. And when the CARES Act brought ERC, and I'll refer to it as ERC just to be simple, when the CARES Act brought the ERC into place, it was not allowed if you had a PPP loan. So since the PPP loan was much more important, the ERC at that point in time was largely ignored. Later in 2020, the Consolidated Appropriations Act was passed, and that changed the law so that businesses that had taken PPP loans could now retroactively claim the employee retention credit. So that opened up the floodgates at that point. The American Rescue Plan Act, which was passed in I believe February, March of 2021, just added on to this. It actually extended between the Consolidated Appropriations Act and the American Rescue Plan Act. It extended the ERC into all of 2021. One thing, as we sit today, so the ERC applies through 2021. However, as part of the infrastructure bill discussions going on in Washington, which seem to be getting nowhere very fast, there has been some discussion about terminating the ERC as of the end of the third quarter of 21 in order to help pay for the infrastructure bill. I have no idea whether or not that will happen, but that's just so you're aware, that has been discussed. My guess is it'll get a lot of pushback, so it may not happen. As part of this, the initial guidance the IRS issued were some frequently asked questions, and I've given you the link there on this slide. That just provided a pretty good background of some of the rules under the ERC. Then the IRS issued notice 2021-20, which was the most comprehensive guidance to date, and the one we'll spend most of the time talking about today. That's about 100 some odd pages of examples, basically, of how to apply the rules. And since then, there have been 3 more pieces of guidance issued notices: 2021-23, 24, and 49, all of which have just sort of added on and clarified some pieces of the rules. But 2021-20 is the most important piece. The first thing you probably should be aware of, and some people, obviously, if you've been dealing with the ERC, you may already be aware of this, but and certainly will not go through all of the rules because it would take hours. But in order to qualify, you must be an eligible employer, and the basic rules there are that you must be carrying on a trade or business during calendar year 2020, and then the rule was extended into 2021. And the operation of your business must be either fully or partially suspended due to orders from an appropriate governmental authority that limited commerce, travel, or group meetings. This rule is a little bit tough to apply because architectural firms, for the most part, were able to continue operations remotely. So for the most part, firms were not fully suspended. Their operations were not completely shut down. You may find that certain of your contracts, however, were suspended, so that it's possible that you could be considered partially suspended because contracts were limited or shut down for a short period of time. However, the best way to qualify for the credit, or the easiest way at least to prove, not that it's a good answer, because it would mean you'd have to have had a significant decline in gross receipts. And what that means is for tax year 2020, you would have had to have a greater than 50% quarterly decline in gross receipts when comparing the same quarter in 2020 to that same quarter in 2019. So obviously, not that you want to have a greater than 50% reduction in gross receipts on a quarter by quarter basis, but if you know, it's certainly the easiest way to document it. In 2021, and we'll talk a little bit more about that later, that decline in gross receipts was dropped down to 20%. So what we are seeing is the 50% decline. While some firms did meet it, unfortunately, in 2020, it's a tough test to meet. The 20% decline in gross receipts in 2021, and that's 2021 versus 2019 as well. That 20% decline, we're seeing that, you know, firms that are still scuffling to recover are meeting that one certainly a lot easier than they can meet the 50% test. So what I did want to do now is sort of talk a little bit about the notice 2021-20, and I'm starting off with so as I mentioned, the notice is set up as a series of Q&As. There's about 70, I believe, questions and answers. The first 48 are important, but again, in the interest of time, didn't want to dive into crazy detail. So I am starting with Q&A 49, which I think starts on page like 73 of the 102 pages of guidance. But that is the guidance that talks about how the ERC interacts with PPP loans, because this is where it gets very complicated and very difficult. The great thing about the ERC is that you get a credit for 2020, you get basically a credit of 50% of the first 10,000 of wages paid to any of your employees during the year, during the periods of time during which you qualify. So basically, so you could potentially get a credit of up to $5,000 per individual for 3 quarters of the year if you qualified for each of those quarters. However, the wages that you use for PPP forgiveness cannot be used for the employee retention credit. So the CARES Act, basically the literal reading basically says that it permits an employer to elect not to take into account certain qualified wages for purposes of the ERC. And so an eligible employer that received a PPP loan is deemed to have made the election with respect to those wages that are included as payroll costs on a PPP loan forgiveness application. And we will go on and talk about several examples as to how this applies and how the IRS has interpreted it. It's a little tricky. So with that said, keep in mind that this guidance was issued in early 2021. By the time it was issued, many of you may have already applied for PPP forgiveness for your first round of PPP loans. And my sense is that a lot of firms took the simplest approach they could in order to get full forgiveness, but yet not spend a ton of time on the on the application. And by doing that, you probably found that you qualified for full forgiveness by just claiming wages during your PPP covered period. And I fully understand why people did that. The problem is, and you'll see from these examples, that may not have been your best answer, because by doing that, you may have used up, you basically have done that election that the IRS talked about, or that the CARES Act talked about. In other words, you have elected to claim wages for PPP forgiveness purposes. By doing so, you cannot use those same wages for ERC purposes. So the real key point to get out of all this, and it's not a simple concept, is going forward, if you have not yet applied for PPP2 forgiveness, is to sort of juggle the wages as best as possible so that you can claim other expenses for PPP purposes, such as your rent, utilities, things like that. Claim as many expenses of other than payroll that you can, so that you leave your payroll for ERC purposes. You really want to be able to try to maximize both of them. And obviously, I think it's most people would agree that it's the PPP loan forgiveness is sort of number one. That's more important, but the ERC is too valuable to just sort of pass on. So this first example I wanted to talk about is just again a very simple example. These are the IRS examples. They don't give all the answers, but they sort of give us a guideline as to how to approach this stuff. So what they're saying here is employer A received a PPP loan of $100,000 and also paid $100,000 of qualified wages that would qualify for the ERC in the second and third quarters of 2020. In order to receive forgiveness of the PPP loan in full, employer A was required to report a total of $100,000 of eligible expenses, I should say, including a minimum of $60,000 of qualified wages, or 60% of the total loan. So as you probably know, you must report at least 60% of eligible expenses as your payroll costs. So in this case, employer A submitted a PPP loan forgiveness application reporting the $100,000 of qualified wages as payroll costs. As I said, that's what a lot of people probably did for the first round. So employer A is deemed to have made the election previously discussed in the CARES Act to exclude $100,000 of qualified wages for purposes of the ERC. So since all of the wages were used for PPP loan forgiveness, none of them can be used for ERC purposes. As we'll see, if the individual here, if the employer here could have claimed 60,000 of wages and let's say 40,000 of rent, then the other 40,000 of wages that they incurred during that covered period could have been used for ERC purposes. And that's a little bit of the next couple of examples. We'll dive into that a little bit. So in this example, employer B received a PPP loan of 200,000, and they had 250,000 of qualified wages that would have qualified for the ERC. So again, they required to have reported 200,000 of eligible expenses in order to get full forgiveness. of which at least 120,000 had to be wages. They submitted their application showing the whole 250,000 of wages as payroll costs, even though they only needed to show 200,000. They just said, let me just show the whole 250 just in case did something wrong. Let me just make sure I've got everything covered. I'll report the whole 250 and be done with it. They are deemed to have made an election to exclude only 200,000 of wages because that's all they had to report. So at least the IRS in this case is saying, you reported 250, but you really only needed to report 200 because that's the amount of your loan. So the other 50,000 of wages that are out there, you will be able to take the ERC on those wages. So from that standpoint, the IRS is being at least a little bit flexible, which we certainly can't always say that about them. Next example, employer C, similar fact pattern. They received $200,000 loan, but they only had 200,000 of wages. They also paid 70,000 of other eligible expenses, such as I said, rent, utilities, things along those lines. In order to receive forgiveness, they would have had to report 200,000 of eligible expenses with a minimum of 120 of wages. They submitted their application reporting 200,000 of qualified wages, so they reported all their wages. But they also, even though they had the 70,000 of other expenses, they did not report that. And as I mentioned earlier, that's very common as to what we've been seeing for at least the first round of PPP. So they unfortunately are deemed to have made an election to exclude the 200,000 of wages, even though they could have reported 130,000 of payroll costs and 70,000 of other expenses. Since they reported 200,000 of wages, they are not eligible to take any of those wages for ERC purposes. So that's why this highlights, I think, pretty well how important it is to be careful about what you report on your PPP application. Next example is the same basic set of facts: 200,000 of PPP loan, 200,000 of wages, 70,000 of other expenses. This employer submitted an application showing 200,000 of wages, but they did report the other 70,000 of eligible expenses. So they could have reported 130,000 of wages and 70,000, but they showed all their wages and all their other expenses. Again, probably just to make sure they covered all their bases. There's so many questions about how to deal with these PPP loans that people were unsure of what to report, and a lot of people wanted to make absolutely sure that they weren't missing something and they got full forgiveness. However, in this case, the IRS says you have made the election, even though you've reported the full 200, because you reported 70,000 of other eligible expenses, you have only made the election to exclude the 130,000 of wages, and therefore you are eligible to take the additional 70,000 of wages into your ERC calculation. So again, in this case, a fairly lenient example of how the IRS is giving some leeway to the reporting. Just a slightly different set of facts here, but same general beginning. PPP loan of 200,000, 200,000 of qualified wages. In this example, the employer paid 90,000 for other eligible expenses. So in order to receive forgiveness, they had to report a total of 200,000 of wages, of which 120,000 had to be, 200,000, they had to report 200,000 of eligible expenses, of which 120,000 had to have been qualified wages. This individual, this business actually submitted their forgiveness application reporting 200,000 of wages, and also reported the other 90,000 of eligible expenses. In this case, because if they take the 60% minimum of wages and the 90,000 of other eligible expenses, that's more than they need to report. So they are deemed to exclude the $120,000 minimum of wage amount that they had to report. And they are allowed to use 80 of their 90,000 of other expenses for PPP forgiveness. So in this case, the additional 80,000 of wages, in other words, the difference between the 200,000 they actually incurred and the 120,000 that they're required to report, that 80,000 qualifies for the ERC. So in this case, the only difference between this and the prior situation was that this business had 90,000 of expenses rather than 70. So they were able to exclude a slightly lower amount of wages and include that additional 10,000 for purposes of the ERC. So that's sort of it. My guess is there may be some questions. We can certainly circle back on the interaction piece of it, and I'll talk a little bit more about some sort of best practice thoughts in a slide or two. But I wanted to sort of go on and talk about a few other pieces of guidance and how some of these things play in. Notice 2021-23 came out shortly after the original notice. It expands on some of the guidance provided in notice 2021-20. In particular, how the rules flow into 2021. So as I mentioned, the Consolidated Appropriations Act took the original, the CARES Act, when it implemented the ERC, it was supposed to end at the end of 2020. I'm sure when the CARES Act came into play, everybody thought the pandemic would be completely over. Everyone would be back to normal and we'd be all humming along by the end of 2020. You know, as we know, since we're now almost a year later, that's certainly not the case. So the Consolidated Appropriations Act extended the ERC into 2021 and expanded on it. So as I mentioned earlier, beginning with the first quarter of 2021, significant decline in gross receipts test is now met if the employer has a decline in gross receipts of greater than 20% when compared to the same quarter in 2019. There was also an alternative quarter test that's allowed to meet the significant decline in gross receipts test. Under this election, an employer may determine if the decline in gross receipts test is met for a calendar quarter in 21 by comparing gross receipts for the immediately preceding calendar quarter with those for the corresponding calendar quarter in 2019. And coincidentally, I literally just, about 5 minutes before I logged in here, I got a question on this from a client who said, we meet the test, so we meet the 20% decline in gross receipts for the first 3 quarters of 2021. Business has picked up. We don't expect to meet it for the fourth quarter of 2021. And she just wanted to know, she said, can I use that alternate quarter test to qualify for the fourth quarter? And the answer is yes, you can. So and if you qualified, in other words, if you qualified for the third quarter of 21, because your gross receipts dropped by more than 20% when compared to the same quarter in 2019, but you then don't meet the test in the fourth quarter, you still qualify for the fourth quarter because you can look back, you basically can look back a quarter. So you can use that alternate quarter test at any time during 21, and that includes looking back to the fourth quarter of 2020 to see if you meet this 20% test. And you could use the alternate quarter test for the fourth quarter of 2020 to qualify for the first quarter of 21. And the alternate quarter test can be helpful, and I realize we're near the end of the year already, so it may not even matter that much, but where the alternate quarter test can come into play is if you know you meet the test up front, you can actually stop making payroll tax deposits. If you know that you will get a credit that's greater than your payroll tax deposits for the quarter, you can stop making the deposits and help on cash flow. In most cases, we're finding that the credits are far greater in dollar amount than the deposits people are making. So that's one approach to look at. Also, and this is a huge change, this last test. Beginning in 21, the maximum credit is now 70% of the first 10,000 of qualifying wages paid per quarter, as opposed to 50% of the first 10,000 per year for 2020. So let's just take PPP loans out of the equation for the moment. If you qualified in 2020 for, just say you qualified for the second, third, and fourth quarters, your business has gotten hit hard, your gross receipts are down, you qualified for all all 3 quarters. And let's just say you've got 10 employees that are making at least $40,000 a year, so they're making at least $10,000 per quarter. Your maximum credit in 2020, even though you qualify for 3 quarters, is going to be 50% of the first $10,000 that's paid during the year. So you would only qualify for $5,000 per employee for 2020. So all 10 employees would qualify, subject to some other rules we'll talk about in a moment. But in theory, let's say all 10 employees qualified, you'd get a $5,000 credit per employee. So you get a $50,000 credit. Now take that forward into 2021. Same facts apply. You continue to qualify for every quarter in 21. And you have the same 10 employees, each making at least $10,000 per quarter. The credit is now 70% of the first $10,000 paid per quarter. So now you're getting $7,000 per employee each quarter. So you're getting a $70,000 credit for the first, second, and third and fourth quarters. So you're what was a $50,000 credit in 2020 for the same business would now be a $280,000 credit in 2021, because you're getting $7,000 per employee per quarter as opposed to $5,000 per employee per year. That's why, and one of the things we've seen is that some businesses are basically taking a step back on 2020 and saying, yeah, I might qualify, but the credit's not huge. Plus, if I've already filed my tax return, I'll have to go back and amend, because the amount you take for a credit, you have to reduce your wage deduction by that amount. So you give a little bit back in income taxes. However, you're still getting a ton more. I just looked at one yesterday where credit was almost $200,000. It cost them about $8,000 in income tax. So they're giving up $8,000 in income tax to get an employee retention credit of almost $200,000. Not a hard decision to make. But so a lot of people just did decide to pass on it for 2020 because it's may not be as large, and it may force them to amend their income tax returns. But for 2021, the income tax returns haven't been filed yet, so you don't have to amend. You just have to be sure to take that into consideration when you do tax planning for the year, because your taxable income may be a little bit higher than what you may have expected. But your employee retention credit will be much larger. Also in 2021, the definition of large eligible employer has been changed to include only employers with an average of more than 500 full-time employees in 2019. One of the rules that stopped some businesses from taking the credit in 2020 is that if you had at least 100, if you had more than 100 full-time employees in 2019, you were considered a large employer and not eligible for the ERC. So whether you took PPP, whether your gross receipts went way down, if you were over 100 employees, you didn't qualify. That definition, 100 employees is granted is a decent sized business, but still plenty of businesses out there are, maybe 150 employees and still could have used the money. That number now jumped to 500 employees. So now I would say somebody with more than 500 employees really is a good sized business. While those businesses still could benefit, if they were eligible, it brings a whole lot more into play as far as, jumping this from 100 to 500 employees. The eligibility really comes into play. The other thing that is important for 2021 is that the employee retention credit may not be taken on the same wages as those used to claim certain credits. And there's 5 different types of credits. 4 of them, you probably, if you do take them, they're probably not worth a ton. Some people may take the empowerment zone credit, but that usually does not turn out to be a big number. The work opportunity credit is something that some people may see as well, but if you do, it may be a decent sized credit. But the numbers 2 and 3, the Indian employment credit and the wage credit for active duty members, probably wouldn't be shocked. I've literally never seen, I don't think I've ever seen either one of those credits ever taken. However, the R&D credit is something that a lot of architectural firms do take. So it is important to keep in mind that the R&D credit wages used for the R&D credit cannot be the same wages used for the ERC purposes. So that's something that you will have to consider when doing R&D credit studies for the year. So that if you've already done an ERC study for 21 and taken the credit, you need to be sure to let the whoever does your R&D credit studies know, so that they don't take the R&D credit on the same wages. So that also, you know, while the ERC is a valuable credit, so is the R&D credit. You may see, because of that, you may see the R&D credits drop a little bit in 2021 because of this rule. Some best practices, and I think we've already sort of touched on some of these. These are some of the things that we've seen as we've gone along. It'll probably one of these are the types of things that will come up as we go, more things will come up as we continue along. But you know, my suggestion to firms is that they extend the PPP forgiveness period as long as possible to maximize the use of expenses other than payroll. I've seen companies come back and say, well, I need full forgiveness by using my wages for an 8-week period, so I'm going to cut it off and file. And I'm like, but if you extended this out to a longer period of time, you know, you've got up to 24 weeks. If you extend it out, you might be able to, you'd be able to take more rent, more utilities, you know, software maintenance costs, or you know, there's other types of costs that are eligible for PPP forgiveness in 21. You can extend those out. If you extend that out, you can take more other costs, potentially as much as 40% of your loan if you have it, and use a minimal amount of wages for ERC purposes. I mean, I'm sorry, for PPP purposes, which would maximize the amount of wages that you can use for ERC purposes. You want to carefully review your expenses to identify costs eligible for PPP forgiveness. So that means really digging in, making sure you've got all your interest, all your utilities, all your mortgage. Make sure you're aware of all the costs to qualify, and make sure you've caught all of those. It's now more important than ever to get as much other costs other than payroll as you can. And as I said, if possible, only use payroll costs equal to 60% of your loan. That's sort of what my starting point would be. If you had a, you know, $500,000 loan, I would say, can you find 200,000 of other expenses and only use 300,000 of wages? Also, don't forget about health insurance costs, pre-tax and employer paid. Those, if an employee earns less than $10,000 in a quarter, the health insurance costs do count as a payroll cost for purposes of the ERC. So if somebody has only worked for your business for a few weeks or a couple of months and has earned less than $10,000, you know, did you pay for health insurance, or was there a pre-tax health insurance plan? And if so, you know, you can always tack on a few extra dollars and get some more of the ERC. And as I mentioned earlier, you also want to coordinate this with your R&D credit provider. Most, if not all, of the R&D credit providers are also doing ERC studies. So it's very simple to, if they're doing both for you, then it's certainly something that they will monitor, and they will certainly allocate in the most advantageous way possible. I want to talk for a minute about ineligible wages, because this is something that is, especially in a small firm, this is something where you can lose quite a bit of your ERC. And it's something that the IRS has done an incredibly poor job of clarifying. And they issued guidance, they recently issued guidance, and when I say recently, I mean, I believe it was early to mid-August, they finally issued some clarifying guidance, which has got a lot of people up in arms. But if you read the rules and if you read the, and I won't bore you with the Internal Revenue Code sections and all that, but if you read the rules and read prior guidance, you'd come to a different conclusion that from where you are today. Very early on, the original CARES Act said that related individuals, wages paid to certain related individuals, to an owner, any owner. So somebody could own 1% of your stock. If you employed the brother or sister, for example, or the children of that employee, their wages were not eligible for the ERC. The only thing I can think of is that the law sort of was trying to say, hey, we don't want you putting your relatives on the payroll in order to get a bigger credit. So we're gonna list all these types of relatives and say if they're on your payroll, they don't qualify. In some cases, it's too bad. I mean, there's plenty of situations where the people were on these relatives were on the payroll prior to any of this. They legitimate employees of the business. They're not, nobody's trying to pull anything over. They're actually working for the business, but that's the way the rule is. But the rule there was and I cannot tell you how many conversations I had with people over the course of the past year about what happens with certain owners. And basically there's this question about what happens with a greater than 50% owner and their spouse. Again, many situations where these people are, you know, the owner and their spouse are on the payroll and both are providing services. A very literal reading of the rule would have said that all owners qualified. Although I know some people that said they read the rule differently, and they said they read it as saying that greater than 50% owners did not qualify. The problem is the IRS never issued any guidance on this. If you read the IRS frequently asked questions, which again, for many months was the only guidance we had, it talks about all these other relatives. It talked about children. It talked about brother, sister, parents, all these lineal descendants. It never mentioned a greater than 50% owner. So based on a literal reading of the rules and the fact that the IRS never commented on it whatsoever, it seemed that you could take it. Again, it was one of those things that wasn't clear. So in notice 2021-49, the IRS finally issued this past August. The IRS finally came up with some guidance, and this guidance was, I mean, I've been doing this a long time, way too long for my taste at times, but this is one of the most insane pieces of guidance I've ever seen the IRS issue. And what they said is that a greater than 50% owner and their spouse will not qualify for ERC if they have any, basically it's not worded like this, but basically it's saying if they have any living relative from this list above, that if they have any children, any brother, sister, father, mother, etc. Even if those individuals do not work for the business. Most related party rules come into play if you have a relative that works for the business. This rule is saying if you have a living relative of any kind, actually I should say not of any kind, but a cousin I don't think applies, but any of these types of relatives listed here, then you don't, and you own greater than 50% of the stock of the business, you don't qualify for the ERC. There's been a lot of pushback, a lot of unhappiness with that rule. It's as I said earlier, some of the rules the IRS has come up with are sort of lenient. This one is unnecessarily harsh. And some people feel that the IRS may still come back and change it. The downside to all this is I know of businesses that have probably taken the ERC and taken it on their greater than 50% owners. So, it's one of those things that will play itself out over time, but I thought it was really important to mention that that is the way the guidance sits as we speak today. And with that, I believe that was all I had to talk about. I know there's a lot, it's a lot to digest in about a half hour or so, but certainly if there's any questions, we can dive into those.
So I just have a quick one on that last one. So the related party, you mean like unless their parents are dead and all of their siblings and they have no children, like even if those people don't work for the company, they're not eligible?
Right. Yeah.
That's-
If you own greater than 50%, as long as you're a 50% or less owner, you
It's
qualify.
fine.
You qualify. You're fine. Yeah. But if you have any of these relatives,
And
don't
they don't work
qualify.
for the business, but you just have them.
You just have them, then you don't qualify. Yeah.
Okay, I'm with you. That's a wild one.
It can be called the orphan rule, I guess.
Yeah, or something. I was trying to think of
I
that.
mean,
Like, are you really I guess you're an orphan if both of your
yeah.
parents
If
did.
literally, it means if you have no living relatives is what it comes down to, which is probably going to be pretty rare.
Yeah, one would hope, especially during COVID. So I just had a couple quick questions just for some definitions, really, hopefully quickly. But in defining gross receipts, I know it's come up before. Is it cash based or accrual based?
Yeah, the rules do refer to an Internal Revenue Code section that we've interpreted to say that if you are a cash basis taxpayer, you take your gross receipts on a cash basis. That's the position we've taken. The IRS has never come out and said that in those exact words, but we believe that's the reasonable position.
So look at how you file taxes and use that same
Right.
method.
My guess is most of the firms on this call are probably cash basis filers. So you would use cash basis.
Yeah. And then you said that the definition of non-payroll PPP expenses. I know that it's changed some over the past. There's been some clarifications. Do you have a good, like a place where we can find that list? Because if we haven't filed for our payroll protection yet, for loan 2, and we do want to spread it out, we need to kind of know what all of those categories are. And I think I read somewhere that they added software, like leasing payments for software and things like that.
Yeah, that's the big one. I believe it's in the instructions to the forgiveness application form. I actually meant to, when I was putting this together, I meant to put a list of as part of the slides, and I forgot.
That's okay. It changes. So I mean, I just know that was different from last year, and a lot of firms pay a lot of our budgets are for, AutoCAD or Revit licenses and things like that. That could help a firm max out the non-payroll. So I'm just always looking for a list. I can dig up the application as well.
Yeah, but if not, let me know and I can get your list. But yeah, software, it's basically rent, utilities, interest, and the software utility, the same items as were as part of the first one, but the software maintenance costs are the big one.
Yeah, that's the big add. The other question is just like a technical question, because I think that you sort of alluded to it, that most of us pay most of our payroll taxes in the first half of the year, right? Because it gets less and less as the year goes on. So if your payroll company files for the ERC, I mean, is it just like you're in line at the IRS and like whenever they process that amended 941 return, that's when they'll send you a check or make the deposit? Is that kind of how it works?
That's how it works. Yeah, unfortunately, and as you may know, the IRS is a disaster right now. So it's for any amended returns that are getting filed, I would say it's going to take some number of months. I've heard some people say 2. I've heard some people say 9 months. So it's
okay. It's more than 2 from us.
More than yeah. So when I heard somebody say 2, and I think it's going to be closer to 9, to be honest.
But I think the important thing is to get it qualifying as quickly as you can, because it's a line basically that you're in the line.
Yeah.
And the other thing is we were solicited by our R&D tax credit firm, and jumped right on that. Oh, we can do your ERC as well. And I've already been working with our payroll company. So I was like, no, thanks. But it's good to know. I don't think that I realized that you can't use them for both. So that's very helpful.
Yeah, no, I know in your case, Ann, I believe you use MassPay, is that correct?
Yeah.
Yeah, MassPay, I think, is one of the, not to talk up any payroll service, but I think MassPay is doing a very good job in this area. And they're one of the few that I know that are actively assisting their clients in doing these calculations. Most of them are just saying, we'll file your amended returns, but that's it.
Yeah, no, they've been great. And they're local, which I kind of like too.
Right.
I feel like I'm hogging the questions. Does anyone else have questions before I keep going?
One thing I wanted to mention, I didn't mention during the presentation, just to make sure it's clear, is that the credit is refundable. So it's over and above whatever you calculate for a credit you get. You know, if your credit's 200,000, you've only paid in 50,000 of taxes, you still get a $200,000 credit. So you'll basically get everything you paid in refunded and then some.
And just so people are clear, which taxes are you talking about?
Well, it's basically a credit. It's a credit against your employer paid Social Security is technically what it is. But it's effectively a credit. But it's effectively what it comes down to is a tax credit. So you basically just get a refund. Is what it comes down to.
Yeah, because most of the time you can't really file before you're filing after you've already the quarter's over. You've done it.
Right.
At least in our case, we were.
Yeah. No, I've seen very few businesses that are able to stay on top of it enough to sort of stop withholding. So most are amending their payroll returns to get the refunds.
Yeah. But it's pretty easy. I mean, my payroll company had no trouble doing it. So definitely, yeah, I would suggest people work with your payroll company if you can.
Yeah, once it's been done once, we've done a few. Now that we've done a few, it's not so bad.
Anyone else? Some questions? Feel free to unmute. You know, it's a lot.
Yeah, it's definitely a lot to. In a half hour, it's a lot to take in. Even in 2 hours, it's a lot to take in.
Yeah, but I feel like the more I do it, the more comfortable I get with the words and the terms and the how it works. So this is really helpful. I just wanted to say, I think if does anyone else? I'm gonna actually stop recording.